Warren Buffett writes an open letter to the shareholders of Berkshire Hathaway every year, which over time has become a mandatory reading for everyone in the investing world. These letters are available on the website of Berkshire and gives a glimpse of how Warren Buffett and his team thinks about investment strategy, stock ownership, company culture, etc. I started reading these letters almost 20 years back and have often gone back to them for better clarity of thought and ideas on how I can improve my investing strategy. And in this video, we have unpacked 9 of the most important lessons that we have come across in this compilation of beliefs and advice from a man who is widely regarded to be the greatest investor in history. Let's begin. Rewarding key managers for meeting their targets via an incentive compensation system is a common practice across companies. But contrary to most organizations, Berkshire Hathaway does not use the stock price as its yardstick to measure performance. In fact, in this 1985 letter, Buffett wrote, and I quote, "We believe good unit performance should be rewarded whether the Berkshire stock rises, falls, or stays even. Similarly, we think average performance should earn no special rewards even if our stock price should soar." Similarly, in the 1991 letter, Buffett complimented the executive compensation plan of one of its subsidiaries, H.H. Brown, which instead of offering stock options or guaranteed bonuses, gives every manager a designated percentage of profits after reducing a charge for capital employed. In other words, each manager at H.H. Brown would receive a portion of the company's profits minus the amount they spent in terms of capital to generate those profits. This puts the managers truly responsible for the decisions that they take on capital allocation, which fits in perfectly with Buffett's version of eat what you kill. It's commonly seen that most investors become price obsessed upon buying a stock and constantly check that stock's price multiple times during the day. I was one of those individuals, and even now I find it difficult to resist that temptation of checking the price many times. In that context, Buffett makes an interesting point when he writes in his 1996 letter, "If you aren't willing to own a stock for 10 years, don't even think about owning it for 10 minutes. Essentially, Buffett drives the point that instead of being bothered with daily movements, one should aim to look for companies that make great products, have strong competitive advantages, and ones that can provide consistent returns over the long run. To illustrate that, let's look into Berkshire's investment into Geico, which is often called Buffett's best acquisition ever. So whenever Buffett saw Geico, it represented everything he was looking for in a company. It had a great brand, a strong management team, and offered huge cost advantages to its customers, which made them come back to the company again and again. In fact, Buffett was so impressed with the company that in 1951, he decided to invest more than half of his net worth in Geico and continued to increase Berkshire's stake in it, especially during the bear markets of 1970s when it was available at cheaper valuations. By 1995, Berkshire owned half of the company, and later that year, Buffett arranged to buy the rest of it, making Geico a fully owned subsidiary of Berkshire Hathaway. The point is, there were many times in those 45 years when Berkshire could have sold their stake in Geico and made a 100x profit. But Buffett was looking to own Geico as a company rather than speculate on its stock price, thereby maximizing its value for Berkshire shareholders. Simply said, always invest with the owner's mentality. Most companies have tangible assets like factories, capital, inventory, etc., and intangible assets like brand and reputation. For Buffett, it's the intangibles that are of utmost importance, but what might come as a surprise is that there was a time when Buffett did not believe in the power of intangibles. In other words, and very early in his investing career, Buffett was a servant of tangible assets and even shunned goodwill-based businesses, as he revealed in his 1983 letter. In fact, it was Berkshire's acquisition of See's Candy Store that changed his outlook and attitude towards intangibles. You see, when Berkshire bought See's Candy in 1972, it had a post-tax income of about $2 million on a net tangible asset base of $8 million. Now, for a shop chain like See's, a 25% return on asset far exceeded industry expectations, which is another way of saying that the business enjoyed a subjective competitive advantage in the form of a favorable reputation. Then, by the time 1982 rolled in, that is 10 years since the acquisition, See's Candy was generating post-tax profits of $13 million on a $20 million net tangible asset base. So essentially, the return on asset had jumped from 25% to 65% over the decade, which supports a wonderful Buffett quote that says, "Goodwill is the gift that keeps giving." Buffett believes the stock markets are generally efficient in the context that timing one's entry with considerable success is next to impossible. But having said this, Buffett in his letters has often emphasized the fact that there are and there will continue to be phases like natural disasters, wars, crashes, bubbles, etc., when rationalism will fly out of the window and will be replaced by emotionalism. In fact, in his 2017 letter to shareholders, Buffett wrote, "Though markets are generally rational, they occasionally do crazy things. Seizing the opportunities then offered does not require great intelligence, a degree in economics, or a familiarity with Wall Street jargon." In other words, Buffett believes that savvy investors should continually look at the fundamental value of companies, and if investors can do that, they'll naturally tend to go in the opposite direction of the herd and derive excess profits from it. This thought process of his is best captured in that famous line he wrote in his 2004 letter, "Be fearful when others are greedy, and greedy only when others are fearful." When Berkshire Hathaway announced in 2016 that it was taking a $1 billion stake in Apple, it left many investors surprised because Buffett had long claimed to have an insufficient understanding of technology and tech companies. In fact, in his 1986 letter, Buffett laid out the different aspects that he and his partner Charlie Munger were looking for in a business, and even went so far to say that if there is a lot of technology, we won't understand it. But this doesn't mean Buffett was inflexible. He just wanted to have a clearer idea of the growth potential, the competitive advantage, and the durability of that advantage before investing in a company or sector. It's in this same line of thought that Buffett in May of 2018 criticized Bitcoin buyers for just hoping that the next guy pays more for an asset which does not hold any intrinsic value. So think twice before you leap into something that's complex for your own understanding. Who doesn't love a bargain? As a student of Benjamin Graham's, it was preordained that Buffett should also imbibe the buy cheap approach. But surprisingly, that was not to be, and Buffett learned a big lesson through a series of poor acquisitions and investments that he had made early in his career. In fact, Buffett writes about one such investment in his 1979 letter, where he refers to his purchase of Wombick Mills, which Berkshire had bought at a price that was lower than the working capital of the business. Now, on the face of it, this seemed like an incredible deal, but the acquisition still turned out to be a mistake for Berkshire Hathaway, because no matter how hard the company tried to turn the struggling business around, it could never get any traction, and the textile industry had simply gone on a spiraling downturn. That experience taught Buffett the importance of return on capital and having an economic moat, which then translated to higher flexibility in taking large or small positions in quality businesses. Or as Buffett puts it in his 2014 letter, "At Berkshire, we much prefer owning a non-controlling but substantial portion of a wonderful business to owning 100% of a so-so business. It's better to have a partial interest in the Hope Diamond than to own all of Rhinestone." Many of us would picture a successful investor as someone who is hyperactive. Someone who is constantly on the phone, making deals for a living, talking to traders, networking, a typical cocktail of Gordon Gekko and Bobby Axelrod. Warren Buffett, on the other hand, advocates a much more passive approach to investing. In his 2005 letter, Buffett went on to explain the virtues of inactivity at the expense of Sir Isaac Newton, who he said should have accidentally discovered a fourth law of motion revealing the inverse properties of motion and returns. Point blank, Buffett is a big advocate of inaction and also uses numbers to show that while the average active stock market investor made only 4% returns from 1997 to 2016, the S&P 500 index as a whole delivered annual returns of 10%. Net-net for retail investors, the real action is in one's inaction. If there's something that infuriates Warren Buffett more than anything, it is this practice of taking loans to buy stocks. Per Buffett, when ordinary people borrow money to buy stocks, they're putting their livelihoods in the hands of a market whose swings can be random and violent, even when it comes to a reliable stock like Berkshire Hathaway. He illustrated this point in his 2017 letter when Buffett showed the 4 major dips the Berkshire stock had suffered in its history, with the price falling by 37% or more in a span of just a few weeks. In that context, he wrote, and I quote, "This table offers the strongest argument I can muster against ever using borrowed money to own stocks. There is simply no telling how far stocks can fall in a short period." And even if your borrowings are small and your positions aren't immediately threatened by the plunging market, your mind may well become rattled by scary headlines and breathless commentary, and an unsettled mind will not make good investing decisions. Buffett often says that buying Berkshire Hathaway, the textile company, had been his biggest mistake as an investor. And there's some truth to this. After all, he had deployed capital into a mediocre, decelerating, capital-guzzling business. And instead, if he had directed this money into insurance companies, he could have made an additional $200 billion in returns over the next 45 years. This compounding nature of time, and by that definition returns, is best described in his 1989 letter, where he says that time is a friend for wonderful businesses and an enemy for mediocre ones. To put it more sharply, Buffett says that holding a business that is not generating value is likely to hurt investors over the long run by not only giving below par returns but also robbing the investor of better investing opportunities. So instead of buying mediocre businesses and praying for them to come to full value, as the classical texts on value investing would say, Buffett advocates looking for quality businesses which are not only capable of generating a healthy return on their invested capital, but are also able to reinvest that capital at similarly healthy returns, thereby making them compounding machines. These types of businesses represent the holy grail of investing, and once you find them, it is in your favor to plant the right seeds and watch them grow rather than continually looking for new flowers to pick. And with this, we come to the end of this video. I sincerely hope this video has helped you get more clarity on the important lessons conveyed by Warren Buffett through his letters to the shareholders of Berkshire Hathaway. If you like this format, then please do let us know in the comments box below, and we shall be more than happy to compile such lessons from great investors which can improve our investing skills and mindset. Please do subscribe to the channel, like this video, share it with your friends, and I look forward to catching up with you next week. Until then.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.